Good morning. This hearing of the Small Business Committee is now called to order. Entrepreneurs play a host of unique and integral roles in the American business world. They are catalysts for innovation, they are engines of job growth, and perhaps most importantly, they are agents of economic turnaround. During the past recessions, small businesses have led the charge towards financial recovery. Today, in the face of soaring inflation and stagnating salaries, we clearly need their help to bring the market back on track. But in order for this to happen, entrepreneurs must have the tools necessary for growth. Targeted tax relief is an important means for encouraging small business development. By promoting investment and research, it spurs entrepreneurial expansion and economic progress. In today's hearing, we are going to look at a number of specific incentives that do just that. Many of the incentives we will examine today were included as part of the Economic Growth and Tax Relief Reconciliation Act of 2001. To make room for other tax measures that benefited large corporations, these were enacted on a temporary basis. In order to further small business growth, they will have to be extended. In moving forward with this task, it is important to focus on those tax breaks that galvanize the job market and bolster emerging industries. Incentives for startups will accomplish that goal. After all, innovation has long been a springboard to economic recovery. For example, the dot-com boom of the mid-1990s pulled us out of decline and breathed new life into the American marketplace. Today, we need to tap that same spirit of innovation. Tax breaks that incentivize tech startups will drive millions of dollars into the economy and create hundreds of thousands of new jobs. With unemployment at its highest point in 5 years, we could use that kind of boost to the workforce. Flexible depreciation schedules present another crucial incentive for entrepreneurs. These provisions encourage small firms to invest in their own growth and development. If business owners are willing to make capital investments, it only makes sense to provide them with the innovation to do so. This particular impetus not only bolsters small firms, but also puts cash back into the economy. Every small business purchase of a good or service gives a needed life to the industry that provides it. Targeted relief does more than advance entrepreneurial development. It also promotes investment in our communities. The benefits of incentives that encourage financiers to put money into small firms in low-income neighborhoods are twofold. These provisions both open up new markets and revitalize struggling regions. Tax breaks that bring jobs and capital to low-income communities will be a tremendous boon to the small business world and the economy as a whole. These kind of incentives, coupled with a number of other items we will look at, present an important means for revitalizing the marketplace. Small firms are the engine that drives the American commerce. When they do well, we all do well. Extending the provisions discussed today will give them the security they need in order to grow and the certainty they need in order to help strengthen and expand our economy. With that, I would like to thank all of the witnesses for taking time of your busy schedule to be here with us today. And I yield to Ranking Member Mr. Shab for his opening statement.
Thank you, Madam Chairwoman, for yielding. And before I turn to the subject of taxes, I want to pause to note the significance of this day, the 7th anniversary of the 2001 terrorist attacks on our nation. The chairwoman, I know, lost many constituents and friends on that day, and our thoughts and prayers are with those who lost their lives and were so affected by that tragic event, and with their families and our brave servicemen and women who are serving our nation, both in this country and around the world. Now, Madam Chairwoman, I want to say that I do appreciate your holding this important hearing on extending the temporary tax provisions commonly known as tax extenders. We have an outstanding panel of experts to advise us today, and I look forward to all their testimony. And a special welcome to Tom Shepard, who's from my district in Cincinnati, Ohio, whom I'll introduce later. Small businesses as well as working families are experiencing difficult times. Gas prices are high, food prices are rising, and people, unfortunately, are losing their homes. Tax relief is absolutely critical to small businesses, particularly in times of economic uncertainty. According to a recent NFIB survey, small businesses ranked federal tax on business income as one of their top 5 concerns. There are many steps that Congress can take to alleviate the tax burden, including eliminating the current tax code and starting over. Our 61,000-page tax code, which has not had a substantial revision since 1986, should, in my view, be terminated. The code's complexity is staggering. For small businesses, most of them, which do not have the resources to hire technical tax experts, it can prove difficult to navigate. According to the Small Business Administration's Office of Advocacy, small businesses with fewer than 20 employees spend over $1,200 per employee to comply with tax paperwork, record keeping, and reporting requirements. Until we terminate the code and start over, which doesn't seem to be on the near-term horizon, unfortunately, Congress must act every year to renew the temporary tax provisions that expire, that they're renewed from year to year is the way we've been handling them up here. This year, Congress must again take up legislation to renew these provisions. This is, in my view, a very poor tax policy and makes it extremely difficult for any business, especially a small one, to budget and plan for the future. However, these temporary tax credits are critical for small firms to grow and create the jobs that help to strengthen our economy. These are the incentives that companies use to develop new technologies, hire new workers, and invest in their communities. Particularly in a time of slowing economic growth, small companies simply cannot absorb tax increases. Renewing the temporary tax provisions is important, but we must also make the 2001 and 2003 tax cuts permanent. They are scheduled to sunset in 2010, so not far down the road. And if they do, on January 1st, 2011, the American people will face the largest tax increase in history, a $683 billion increase. According to the Joint Committee on Taxation, failing to extend these cuts would cause 31 million families with children to pay an average tax increase of $1,025 because of the reduction in the value of the child tax credit from $1,000 down to $500. Almost 30 million married couples will have to pay an average tax increase of $686 resulting from the return of the marriage penalty. 91 million taxpayers will have to pay an average of $498, so almost $500 more because of the loss of the 10% tax bracket, which is lower than most. 5.5 million taxpayers who were benefiting from the deduction for student loan interest and employer educational benefits will have to pay an average of $286 more in their taxes. 2 million families who adopt a child will pay an average of $156 more in taxes. 28 million savers and investors will pay an average of $1,800 more in taxes due to the end of lower tax rates on long-term capital gains and dividends. The 2001 and 2003 tax cuts included an across-the-board cut for all working Americans, which is vital since 85% of small businesses file as individuals. According to the Heritage Foundation study, the failure to renew these cuts would cost the Cincinnati area, my community, the economy there, approximately $200 million annually in economic growth, including 1,900 lost jobs and a tax increase of $1,300 per taxpayer per year. At one of our committee hearings, the issue of flow-through income when business owners include company revenues on their individual income tax returns was raised. As one small business owner testified, quote, "Many folks in Congress think they are raising taxes only on the wealthy, but I'm here to tell you that these rate increases will strike at the heart of small businesses," unquote. One final point. For the overall health of the economy, Congress must curtail wasteful federal spending. Cutting spending and working towards a balanced budget is critical, not only for our economic security, but also for our national security. These steps would help small businesses through our current economic challenges. I look forward to hearing the recommendations of our distinguished panel of experts here this morning. And Madam Chairwoman, I again want to thank you for holding this important hearing, and I yield back the balance of our time.
Thank you. And it's my pleasure to welcome our first witness, Mr. Faraci. Mr. Manning Faraci is Vice President of Federal Affairs to the National Biodiesel Board. Prior to work for NBB, Mr. Manning served as the Chief of Staff to Congressman Kenny Hulshoff. Founded in 1992, the National Biodiesel Board is the national trade association representing the biodiesel industry as the coordinating body for research and development in the United States. Mr. Faraci, you have 5 minutes.
Great. Chairwoman Velasquez, Ranking Member Shabbat, members of the committee, on behalf of the National Biodiesel Board and the many small businesses that make up our trade association, certainly appreciate the opportunity to be here today to tell you about the importance of the biodiesel tax incentive to our industry. The National Biodiesel Board, as I alluded to, we're the trade association for the U.S. biodiesel industry, and we represent the breadth of the entire industry. You have everything from the producers who are actually making the fuel, to fuel marketers, the feedstock providers who are providing the material from which we're making the fuel. So we have a pretty good perspective in terms of what's going on in the biodiesel industry. Biodiesel itself is a diesel replacement fuel. It's produced typically from animal fats or vegetable oil. Soybean oil is typically the feedstock that's used in the United States. However, I think that you've seen over time, you've seen an increased diversification in the feedstock that's used. And you basically react the animal fat or the vegetable oil with alcohol, remove the glycerin, and refine it till you hit a fuel specification that's determined by an international consensus body known as ASTM. We take very seriously fuel quality efforts. We vigorously test our fuel. We encourage our members to engage in our fuel quality program because consumers have to be confident that we're putting a quality fuel into the marketplace, and we'll feel confident that we are. In the marketplace, our fuel is typically blended with conventional diesel fuel. Usually it blends of 20% or below in the marketplace. And typically what you have are below the rack jobbers who are buying the fuel from our plant and blending it below the rack. We have penetration at about 42 fuel terminals right now. And just to give you some perspective, there's 1,500 fuel terminals nationwide. Ethanol's at about half of those terminals. We're at 42. Now we expect that number to go up over time, and we certainly want to see that happen because our goal is to get greater penetration into the fuel infrastructure so that we get to more consumers with our fuel. The tax incentive that I want to visit on here briefly was initially enacted in 2004 as part of the American Jobs Creation Act, subsequently extended as part of the Energy Policy Act of 2005, and expires at the end of this year. It's a $1 per gallon blender's excise tax credit that you get if you make the fuel from virgin vegetable oils or animal fats, or it's 50 cents per gallon if you make it from second-use oils such as yellow grease or restaurant grease, for example. The fuel has to meet ASTM D6751, which is the fuel specification and Section 211 requirements of the Clean Air Act to qualify for the tax incentive. And the credit is claimed at the point that the biodiesel is blended with conventional diesel fuel. And everyone who claims that has to register with the IRS to claim that credit. And the one commentary that you can make on the existing biodiesel tax incentive is that it's working. And all you have to do is look back. In 2004, when the credit was enacted, we had 25 million gallons of production in the United States. In 2007, we had 500 million gallons of production in the U.S. So if the idea is to increase the production and use of biodiesel, there's a pretty compelling case to be made that the biodiesel tax incentive is working. And not only is it working, there's a very compelling public policy rationale to be made for why we should encourage the production of use of biodiesel in the United States. The first and most obvious is it's going to reduce our dependence on foreign oil. The 500 million gallons of biodiesel produced in the United States represents, displacing 20 million barrels of oil. Ours is an extremely efficient fuel. We have a 3.5 to 1 energy balance. So that means for every unit of energy it takes to make a gallon of biodiesel, you get 3.5 units of energy out of it. And those are numbers that come from NREL, so they're extremely credible. So we're an efficient fuel that's going to help reduce our dependence on foreign oil. We're extremely good for the environment. You know, the USDA DOE model has us as reducing greenhouse gas emissions by 78%. And most importantly, we're creating good green jobs in rural America. You know, we support over 21,000 jobs, add $4 billion to the U.S. economy in 2007 alone. The most important thing, though, is that all these benefits that we get are all in jeopardy if the tax incentive is not extended, because it ends at the end of this current year on December 31st. Absent that credit, because the way it functions is to make biodiesel price competitive with petroleum diesel fuel. Absent that tax incentive, and not trying to be dramatic, our guys just are not going to produce fuel. So, Madam Chairwoman, Ranking Member Shabbat, appreciate you having this hearing. It's absolutely vital to our industry that this tax incentive be extended, and I'd be willing to take any questions you may have.
Thank you, Mr. Farashi. Our next witness is Mr. Joseph E. Clements. Mr. Clements is a restaurateur from Baton Rouge, Louisiana. Mr. Clements is also a certified public accountant by training, and his company, Clements Management, currently operates 9 Burger King restaurants in central Louisiana. Mr. Clements is here to testify on behalf of the National Restaurant Association, founded in 1919. The association is the leading business association for the restaurant industry. Welcome, sir.
Thank you, Madam Chairwoman. Mr. Shabbat, I'd like to thank the members of the committee for the invitation to offer testimony today on behalf of the National Restaurant Association about ways in which to update the tax code and help stimulate the economy. As stated, I've been in the restaurant business for 13 years, and I currently own and operate 9 Burger King franchise restaurants in Louisiana, and I employ approximately 300 people. Prior to my entry into the restaurant business, I practiced public accounting for almost 19 years, where my firm provided services to small businesses just like the one I own today. I'm here today to discuss the need for reforms in the depreciation schedules, specifically to shorten the lives of the write-off of the restaurant buildings and improvements to 15-year lives. This would create an immediate economic activity within the industry, which in turn would reverberate throughout the economy. There's currently legislation pending in the 110th Congress which addresses accelerated depreciation. H.R. 3622, championed by Congressman Kendrick Meek of Florida and Patrick T. Berry of Ohio, would make permanent a 15-year depreciable life for newly constructed restaurants as well as for improvements on restaurants. The bill currently enjoys bipartisan support with over 160 co-sponsors, including 18 members of this committee. There's no question that restaurant depreciation schedules are outdated. According to the tax code, restaurant buildings have a useful life of 39 and a half years, over which they can be written off. To suggest that a restaurant building's useful life is 39 and a half years is just ludicrous. The wear and tear on restaurant buildings is probably greater on this type of building than on any other type of building. Indeed, this is evidenced by the frequency by which restaurant buildings are remodeled, renovated, or even rebuilt. Over the years, Congress has made many changes to the depreciation schedules. There have been changes that have split the industry between leased properties and owner-occupied properties, and there have been changes to specific industries which are competitors to the restaurants, such as convenience stores and gas stations. And there have been changes allowing faster write-offs for improvements, but not for new construction, placing certain businesses in an economic disadvantaged position. I maintain, however, that the tax code should not pick winners and losers in the restaurant industry, but it should allow a level playing field on which all can play. And finally, it is widely recognized that the restaurant business is one of the more risky ventures that one can undertake in our economy. Opening a restaurant requires an enormous investment in capital, most of which is spent on the building or the improvements. Most restaurateurs finance their buildings or improvements over a 12 to 15-year term. Adjusting the depreciable lives to match these terms more closely reflects the actual cash expenditures of the asset. The purpose of this hearing is not to discuss the merits of this issue, but rather to, more importantly, whether this tax provision will help small businesses and hence spur growth in a struggling economy. We believe these changes will have a dramatic and immediate effect, given that the average cost of an update or remodel in a restaurant ranges from $250,000 to $400,000, according to the NRA. Or in my personal case, a new Burger King restaurant cost $800,000. This year alone, the restaurant industry is expected to spend in excess of $5.5 billion on capital expenditures for building construction and renovations. These are dollars that will be spent in the construction industry and will further grow the economy. And finally, if there's any question as to whether this provision would immediately spur activity, look at what happened when Congress enacted the provision to provide restaurants with a 15-year schedule on improvements made to restaurants from the 2004 bill. The following year, in 2005, the year that the provision went into effect, the restaurant industry spent more than $7.4 billion on new structures and improvements, a 42% increase over the $5.2 spent in 2004, according to the Census Bureau. Additional spending fueled by a shorter depreciation schedule created thousands of jobs in the construction-related industries across the country. With a more predictable schedule, we anticipate that these spending numbers will grow as restaurateurs have the ability to plan new construction and improvements farther out than 1 or 2 years. All of this information is addressed in my written testimony, as well as a detailed explanation of the issues. In respect for everyone's time, I will not read the rest of them today, but I'd ask that you look at them in the written testimony. We urge the members of this committee to consider this information as evidence of the need to help the restaurant industry keep strong in order to keep the nation's economy overall strong. Again, I'd like to thank you on the behalf of the National Restaurant Association for the opportunity to provide this testimony, and I thank those members of the committee who have co-sponsored this legislation, and we appreciate your support. I'll be happy to answer any questions that you may have on this information.
Thank you, Mr. Clemens.
Thank you.
Our next witness is Mr. Larry Kilduff, is the president and managing member of the Kilduff Company based in Milwaukee, Wisconsin. The Kilduff Company is a privately held real estate development company. Mr. Kilduff has over 22 years of involvement in retail and other commercial development projects across the country. He's here to testify on behalf of the International Council of Shopping Centers. With over 75,000 members, the ICSC is the leading trade association of the retail development community. Welcome.
Thank you, Madam Chairwoman. As mentioned, my name is Larry Kilduff. I am the chairman of the Environmental Policy Committee and the recent past Central Division Government Relations Chair for ICSC. I'm also the founder, to supplement that volunteer work, of the Kilduff Company in Mequon, Wisconsin. The Kilduff Company participates in development and consulting projects in retail marketplaces around the country. However, our passion and specialty is urban redevelopment and revitalization. We've made an indelible mark in neighborhoods throughout the United States by applying unique talents and philosophy to assist communities and individual developers in their economic renovation efforts. I am here today representing our trade association, the International Council of Shopping Centers, which was founded in 1957 and is currently more than 75,000 members strong in over 90 countries, including shopping center owners, developers, managers, marketing specialists, investors, lenders, retailers, and all other professional endeavors that participate in our industry, including academics and public officials. I'm here today specifically because of the concern over the so-called tax extender legislation and that it continues to languish. This legislation contains a number of tax provisions that expired at the end of 2007 or are set to expire in 2008. In particular, ICSC supports the immediate extension of the 15-year depreciation for leasehold improvements, brownfield expensing, the new market tax credit, and a number of energy tax incentive provisions. One of the most important obligations of a shopping center owner is to provide modern, efficient, and environmentally sound retail space for tenants and the public. Owners must periodically refurbish or replace, usually every 5 to 10 years, many components of their buildings. Sometimes these requirements are in the lease and they're required to be either paid for by landlords or paid for in part by landlords through incentives back to the tenants. The 5 to 10 year lease period is fairly common in our industry. These improvements can be fairly substantial. They can include HVAC, they can include interior walls, plumbing, electrical, things that have to comply with ever-changing codes for building construction and also for environmental improvements. The 15-year depreciation period for such leasehold improvements more closely reflects, although it doesn't perfectly match, but it does more closely reflect the active life of these improvements and the market practices in today's environment. In Alaska, a friend of ours who owns a family shopping center, they've owned it for many, many years and developed it in Anchorage, and as it's continued to grow, it's become a major shopping center in that area, and yet is still a family-owned business, is faced with the dilemma of having to try and make a decision as to whether to make a substantial renovation of the property. With a 15-year depreciation schedule and a shopping center of that size, notwithstanding the size of the shopping center, the owner is small. The margins are very thin, and the decision to go forward may or may not be completely reliant on the possibility of the depreciation schedule being 15 years and being made permanent. Brownfield remediation expensing is also very important to small developers. As a small developer who focuses on urban projects, I wrestle with my share of environmentally contaminated properties and developed a good deal of experience with these properties, both with the cleanup of brownfields and assisting others in that endeavor. Just as my Alaska example shows, with the leasehold depreciation schedule, this program for remediation expensing is vital. I'm currently involved in a project in the early due diligence stages in Kenosha, Wisconsin. It's a 40-acre mixed-use development adjacent to retail and commercial that consists primarily of senior housing and multifamily residential. This is an infill project that will ultimately, upon completion, generate a tax increment of over $80 million. And while my company is small, the group of people that we have put together to do a project of this magnitude is looking forward to doing it. It's adjacent to a landfill that has been active for over 30 years. This landfill is part of the project. Without the cleanup of that landfill, this project can't go forward. The property is owned by the same people. The city is afraid to test it. The landowner doesn't want to test it. Nobody wants to know what's in it until they know how they're going to pay for cleaning it up. And this could very well affect our ability to go forward. When we measure risk profile for a project like this, if we look at it and say we don't know what it's going to cost to clean it up, we won't know what it's going to cost to clean it up until we test. Once we test, we may have to acknowledge what's in there, and somebody in this picture is going to be responsible for it. We have to look very, very hard at whether or not we can even make that effort. Knowing that you could at least appreciate the expense of that cleanup can have a major impact on that. It would, with urban projects, it's also very important to mention that anything that can measure or level the playing field with risk can be very, very important. And I would urge you to also consider the bill that was forwarded by Mike Turner and Stephanie Tubbs-Jones. I realize there's no time for Congress to pass H.R. 3080 this year, the Brownfield Cleanup Act, but Representative Tubbs-Jones understood that making the transferable tax credit available to small businesses could tip the balance in that very decision-making. We also do support new market tax credits. The process is cumbersome and sometimes doesn't do as good a job as it could, but it also falls into that category of things that help balance the imbalance in urban redevelopment. And then lastly, we would also look at your support for commercial tax, building tax deduction, and carried interest. We believe that the carried interest problem is significant as it relates to the small businesses in this country, and I would love to entertain questions on that if you have any interest. At this time, I think I would just like to thank you for, Madam Chairwoman, for your prompt enactment of the tax extenders legislation. It's necessary for the economic growth, job creation, and capital investment in energy security, and ICSC looks forward to working with you and the entire Congress on doing so. Thank you very much.
Thank you, Mr. Kilduff. Our next witness is Mr. Leo Belingieri. Mr. Belingieri is the Chief Executive Officer and President of MKS Instruments in Andover, Massachusetts. MKS Instrument is a global provider of process control solutions for advanced manufacturing processes. He's here to testify on behalf of Semiconductor Equipment and Materials International, or SEMI. SEMI is the global representative of the microelectronic ecosystem industry. Welcome.
Good morning. Thank you, Madam Chairwoman and Ranking Member Shabbat, and for the committee for having me here today to speak. As Madam Chairwoman noted, I'm the CEO and President of MKS Instruments, so part of the interest is personal to MKS Instruments, but also I will be the chairman on the North American Advisory Board of SEMI beginning next year, and we represent about 800 companies involved in the semiconductor, photovoltaics, and display industry, of which about 80% of those companies are small businesses. So I'm speaking in behalf of both organizations. We provide products to equipment makers involved in semiconductor manufacturing, displays, and photovoltaics, and other advanced technologies. Today, I'd like to talk about two components of the tax extenders bills that are of great importance to MKS and the other semiconductor companies and semi-members. These issues are the R&D tax credit and the commercial investment tax credit for solar energy. In terms of the R&D tax credit, MKS Instrument employs about 500 engineering professionals. We expect to spend about $80 million in R&D this year. That's about 10% of our revenues, and that is fairly common for the industries that we represent. R&D spending goes towards the salaries for our engineering people, engineering consulting, and towards the cost of materials for R&D and for the tools we use. An initial R&D investment of $1 million or slightly more than that, reoccurring each year, generates about $11 to $12 million of revenue each year. And over 5 to 7 years of a product life cycle, that would be somewhere between 50 and 75 million in revenue over that life cycle. So the R&D tax credit is an important incentive to locate this value-added investment in the United States. In addition to these jobs, there's really a direct benefit to the U.S. government, and I did a couple of quick back-of-the-envelope calculations. We estimate that the typical R&D credit for us gives us about $2 million of credit. As a conservative estimate, if you look at about a 15% profit level, pre-tax profit level on that $50 million in revenue resulting from the R&D projects, that would give us a profit of about $7.5 million. We assume that the tax rate at 36% for business would provide a return in the corporation taxes to the government of about $2.7 million, and that excludes the additional tax benefits from hiring people in the R&D area, so their actual personal incomes, as well as all of the supply chain that would be either providing materials or services for us as well. The R&D tax credit has a long history of strong bipartisan, bicameral support, and it's unfortunate that it expired 8 months ago. Growth of the American economy is closely tied to the ability of our companies to make sustained commitment to long-term investment in R&D. The credit provides a critical, effective, and proven incentive for companies like MKS to increase our R&D spending in the United States. It's a stimulus for U.S. investment, innovation, wage growth, consumption, and exports. While the R&D tax credit is expired, many countries such as Ireland, Canada, and China have more attractive R&D tax incentives, luring research jobs away from the United States. The United States used to have the best R&D tax credit, and now we've moved way down the ladder in that list of countries. They have made it a priority, and we have not. I urge Congress before adjournment to enact a seamless, multi-year extension of a strengthened R&D tax credit. The second issue is the commercial investment and tax credit for solar energy. Solar energy is a new market for MKS Instruments and many of the other semi companies as well. The materials and equipment used in semiconductor industry is very similar to what is to be used in solar energy industry. At the time when America's energy independence is more crucial than ever, solar energy and other means of alternative energies are expected to boom. The commercial investment tax credit for solar energy expires at the end of this year. Unfortunately, due to the uncertainty of an ITC extension, solar projects in the United States have already been put on hold. The commercial ITC for solar energy is critical incentive for companies to locate their solar energy manufacturing facilities and projects within the United States. Again, just like the R&D tax credit, these investments produce jobs. According to a Navigant consultant study, if extended, the solar energy ITC is expected to create almost 40,000 more jobs and about $8 billion in investments. If it is not extended, those jobs and investments will go elsewhere. Other nations have very generous incentive packages for solar energy and are leading in the investment in this area. If Congress fails to extend the credit, it will cause America to fall further behind and ensure that these investments are made overseas. There's no doubt that our country will be a user of solar energy. The question is whether we'll be a producer of the equipment and the panels and the installation kits. I urge Congress before adjournment to approve an 8-year extension of the commercial investment tax credit for solar energy. In closing, let me reiterate, what is at stake here is American jobs and investments in crucial technologies. Tax policies are a key factor for companies when they are deciding to invest, and we are faced with some stiff competition abroad. This is very limited window of opportunity to extend the credits this year. I urge Congress to make this a top priority, ensure that the R&D tax credit and commercial investment tax credit for solar energy are extended before Congress adjourns. We cannot afford to wait. I thank you, and I look forward to any questions that I can answer.
Thank you, Mr. Berlingueri. And now the chair recognizes the ranking member for the purpose of introducing our next witness.
Thank you very much, Madam Chair, and I'm pleased to introduce Tom Shepard, who's Chairman and CEO of the Shepard Chemical Company, which is based in Norwood, Ohio, which is in the 1st Congressional District, the district that I have the honor to represent. And he also has the Shepard Color Company. Both companies are family-owned small businesses with over 400 employees. Shepard Chemical was established back in 1916, and Mr. Shepard is the 4th generation Shepard to run the family businesses. Mr. Shepard serves on the Executive Committee of the American Chemistry Council and chairs its Small Business Council. He's also a member of the Executive Committee of the Cobalt Institute. He received a BA in biology from Princeton University and a master's degree in management from Northwestern University. We're pleased to have you here today, Tom, and we look forward to your testimony.
Thanks, Mr. Shabbat. Thank you, Ms. Velasquez, and members of the committee. I represent only Shepard Chemical and Shepard Color. We're custom and specialty metal-based chemicals manufacturers that make life better, safer, and healthier. Our core purpose is to have a positive impact on people's lives, specifically our employees, our customers, our communities, and our shareholders. Central to our strategy is the development of engineered products and innovative technology. This is what we like to do, and this is what allows us to compete successfully around the world. R&D, as you know, can be expensive. We rely on dozens of chemists and engineers and millions of dollars in technical assets to create new and novel materials for a wide variety of uses. Recent developments include additives for high-pressure lubricants, gas generants for airbags, infrared reflective pigments for cool roof technology, cathode materials for lithium-ion batteries, additives for biodegradable plastics, and catalysts for sealants for energy-efficient windows. My company takes full advantage of the research and development tax credit, but I need to tell you that I'm quite conflicted about this program. On one hand, it brings welcome relief from our onerous tax burden. I believe our government is wise to let my companies keep more of the money we have earned, and we are happy to do so. I assure you we invest that money wisely. Also, of all the things that our government does with the taxes we pay, investing in businesses and activities that create value and jobs is one of the best. When business is encouraged and not discouraged, lots of good things happen. On the other hand, I believe businesses should invest in research and experimentation because it is good for that business. To invest for other reasons, such as gaining a tax credit, seems to be a bad idea. So if the purpose of the tax credit is to stimulate and reward investments in research and experimentation, I might urge you to consider what is surely a more effective and efficient way. My suggestion is to reduce the income tax in general, and especially, if small business performance is the target, the estate tax, which is especially detrimental to small businesses, to eliminate the state tax, which is especially detrimental to small businesses. If our government were to lower taxes, the reward for creating value would increase. If the reward for creating value were to increase, more people would try harder to do so, and if more people tried harder to do so, more would succeed, and more value would be created, and more jobs would be created, and more people would be self-sufficient, and fewer people would be in need of assistance, and more people would have the means to take care of those that are. So government would have to spend less, and if government had to spend less, they could tax us less, and the whole cycle could play out again. I really believe it's that simple. Unfortunately, over years, we've made it complex. However, in the likely event that taxes continue to be levied as they are today, and if we are intent on spending them for the betterment of America, I believe doing so in support of businesses and activities that create value and new jobs is a good investment with a strong payoff. If this is the case, then I am strongly in favor of the R&D tax credit. I do have one caveat. My understanding is that the R&D tax credit saves my companies about 15% of our yearly increase in research and experimentation expenditures. While I do not turn up my nose at this kind of money, it's not nearly enough to influence how I invest in R&D. I invest in R&D because it makes sense for my business, not because of the R&D tax credit. If given the opportunity, I would love to talk about the estate tax. Thank you.
Thank you, Mr. Shepherd. I would like to address my first question to Mr. Faraci. For small communities, the biodiesel tax incentives has been the linchpin of small business development and investment, especially in rural America. Can you explain the link between the tax credit and rural communities?
Absolutely. You're absolutely correct. I mean, what you saw at the beginning of the biodiesel industry is when it was in its infancy, and even as it's continued to grow, is that given the opportunity to add value to their agriculture products, you had soybean farmers who would come together and form cooperatives and then hence do biodiesel production facilities. Now, the industry's matured beyond then, but if you take a look at where we're located and where we're producing jobs, it is largely in rural communities. So not only do you have the jobs that you're getting in the plants, but you have everything in the fuel distribution chain. You have everything that you're getting from the agriculture community as well, and various feedstock providers, and adding value to their products. So I think that in terms of job creation in rural communities, we add a lot.
You mentioned that in 2004, when it was the first year that the biodiesel tax incentive was in effect, we have an output of only 25 million gallons of fuel. And then today the output is up to 500 million. Do you have any data that shows how many jobs are created as a result of that?
Sure, and a study that we had commissioned internally to get a good handle on that. Right now in 2007, we supported over 21,000 jobs, added over $4 billion to the overall economy from our industry. And if you go out to these biodiesel plants and you see them, typically they're smaller producers, and they are small businesses for the most part. Just to give you some perspective, I mean, the larger side of our facilities are going to be 100 million gallon production. That's as big as it gets. But your typical plant is going to be a 15 million gallon plant or smaller. And it'll be a small number of employees, but they're doing good paying jobs, good green jobs, and that are obviously of benefit to the local community.
And if the tax incentives will continue, will be extended, do you have any numbers as to how many jobs will be created in the near future?
Sure, and again, the same analysis that we had done of what we would anticipate to have in the industry happen if the tax incentive is extended. We'd expect to have create a projected a little over 38,000 jobs, add another $26 billion to the economy between now and 2012. But you touch on a great point. I mean, the extension of the tax incentive is extremely vital to that, because the way that functions is it makes our fuel price competitive with petroleum diesel in the marketplace. And there's a compelling public policy reason to do that from energy security standpoint, obviously the job creation standpoint, the environmental standpoint. But the way the credit itself functions is that if it goes away, all of a sudden our fuel is a lot less competitive. And right now, obviously, where fuel prices are, consumers are very sensitive to that. And I think that you would see production in the industry all but halt or be severely curtailed at the least.
Thank you. Mr. Clements, in your testimony, you focused on the importance of the 15 years depreciation schedule for qualified restaurants improvements. And this credit expired on December 31st, 2007. Given that we are 9 months into the year and it has yet to be extended, have you seen any projects or either delayed or terminated because of the fact that that it expired and it has not been extended?
I've not seen that personally, but I do have a situation where people in 2007 saw an opportunity to develop a new restaurant. I know specifically of one fellow franchisee of mine that began the process in 2007 based on the understanding that, and expectation that these extenders would be passed. He started the project. He's now almost complete with the project, and he's sitting in a very different financial situation today than he was when he started the project because the extenders have not been put together in past. So that situation could have affected that building project. I can't say for certain it did or did not, but certainly the fact that you can match the cash flow of the tax depreciation and the taxes to the payment of the building, the cost of the building or the improvements, certainly allows for an accelerated interest in the project.
Thank you. Mr. Bellingieri, a recent study revealed that over 25% of companies claiming R&E credits have assets of less than $1 million. Those are small businesses. Can you talk to us about the importance of the credit for small businesses making significant investment in research, and how does it create opportunities for future expansion?
I think one of the key things in the industries that I'm involved with and representing SEMI in is that our industry is very dynamic and things change very quickly. And so in order to be a leader in producing either semiconductor chips or solar panels, it's required that on a regular basis we change the technology and bring lower cost to be able to produce products. In the supply chain that we have, as I mentioned, many of them are small businesses, and also with SEMI itself, 80% of the members are small businesses. That investment allows us, as I mentioned, that back of the envelope calculation, we're often able to get about 10 times the revenue per that investment. And so what that does is provides manufacturing jobs for all of those companies. They're suppliers in producing materials or machine parts or services. So it has a cascading effect completely down our supply chain in terms of creating employment and in revenue, I think, for the government as well.
Very good, thank you. Mr. Keldoff, the tax extender that allowed for a 15-year write-off on this whole improvement, I know that is critical to your industry. This committee have held hearings on the tax code, and we have heard from many entrepreneurs about the need to modernize the tax code. Can you discuss the economic effect that outdated provisions can have on small businesses?
Yes, ma'am, I can. With particular regard to the leasehold depreciation portion of this, most shopping centers, and our industry is made up of a vast number of different types of people. The larger developers tend to make all the headlines and make the biggest projects, but there are an enormous number of smaller developers. My company, I have 4 people in my office. And we're able, with a small office, to put together coalitions of capital partners and others to make big projects go. The reality is that most of those shopping center owners are owning shopping centers that are 75,000, 80,000 square feet, might have a majority of that space be leased to small tenants. Those tenants turn over on leases every 5 years. And if you've got a Subway sandwich shop in a particular space and they move out in 5 years and somebody wants to put a dental office in, you literally have to tear out all of that work. And you can be 4 or 5 tenants down the road on a 39-year depreciation schedule, still amortizing that first tenant. And so it's a significant impact,
Thank you. Now I recognize Mr. Chabot, and then I'll have other questions for the second round.
Thank you, Madam Chair. Mr. Frauci, I'll begin with you if I can. Back in April, I toured one of the companies in my congressional district. It was the Peter Kramer North American Company. It's a full-line oleochemical supplier. And during my visit, one of the folks there, his name was Michael Dow, he was one of their account executives, stressed that if the production tax credits were not extended, it would be almost impossible for them to make a profit. Is that unique to them, or do you think that that's the case in a lot of businesses across the country?
Peter Kramer's a member of ours, and glad you were out to see their facility. I'm sure it was impressive. They, the experience that you heard there at your plant visit would be the exact same thing that you would hear at pretty much every other biodiesel plant that you went to, large, small, multi-feedstock, it wouldn't really matter. They would tell you the same thing, given the important role that tax incentive plays in making us price competitive in the marketplace.
Okay, thank you. And you had also mentioned in your testimony that about the efficiency of biodiesel, and I think you mentioned that it was about for every, the input being 1, the output is like 3.5 times
Yes, sir.
the output. How does that compare with ethanol? Could you comment on that?
I'm not sure. I've seen different numbers for ethanol. Ethanol has a positive energy balance. I believe ours is higher. 3.5 to 1 is an extremely efficient fuel.
Yeah. The numbers that I remember are pretty close, actually, not to yours, but I think you got as much energy out almost as you put in. And so there was a real concern about that, especially arguably if you're driving up food costs and other things at the same time. So it sounds like you all are quite efficient, and I think it's something that bears looking into. Mr. Clements, if I could go to you next. Restaurants are often, open long hours and experience high customer traffic and renovate frequently. And could you expand a little bit on the importance of the 15-year depreciation schedule? I know you mentioned that Pat Teaberry, and we have a lot of bills. That's something after this meeting that I'm going to go back and look at very closely, because I know philosophically over the years we've been in favor of that, and I'm inclined to go on that bill myself as well. So if you could just talk about that briefly.
I'd be glad to. Perhaps the best way to approach it is to let you hear an example in my own situation.
Okay.
I'm a Burger King franchisee. I sign a franchise agreement for every location that I operate, and it's a 20-year agreement. Within that 20 years, I'm required to do a pretty substantial remodel at 10 years. Obviously, I have to maintain the facility and keep all the repairs and maintenance up and keep up with the cosmetics and decor of the day. At the end of 20 years, assuming I want to renew that, and in most cases I would, then I've got to do beyond a substantial. It's almost, in a lot of cases, what we would call a scrape and rebuild, where I tear the facility down and I just completely rebuild it. Or I'll go down to the concrete and 4 walls and put a new roof on it, put new air conditioners on it, put new interior walls, new plumbing, new electrical. So I have just about rebuilt the entire building. And yet I'm only halfway through the life of the 39.5 years. So from an economic standpoint, I'm sitting there still trying to figure out how to write off the rest of the building from the first round, and I'm incurring just about as much in cost on the second round. So I hope that helps explain the scenario.
Yes, thank you.
Okay.
Mr. Shepherd, let me go to you next if I can. You had, I think, concluded in your testimony by saying, and I quote, I believe, if given the opportunity, I'd love to talk about the estate tax.
Yeah.
So I'd like to give you that opportunity.
Thanks very much. For my company and many small businesses, we are privately held and we are an S corporation, so all of the profit from our company flows through to the owners, and we pay taxes not on our salary but on the entire profit of the company. Every year, almost 50% of that income is taxed. And it is so for my entire working life. I'm fourth generation, as Mr. Shabbat mentioned. I have a strong desire to pass it along to my kids, who I think are so far looking like they're, going to be capable of handling this. Every year, or when I die, depending on what the law is at the time, maybe 50% of the accumulated wealth will then again be taxed. So 50% tax on income throughout my life, and then another 50% on the accumulation when I die. We, of course, are preparing for that. We expect it to happen. I'd love for it to not happen because it's an incredible waste. Every year, my salary, which is typical for my position in the marketplace, is more than completely consumed by taxes on that salary and premiums to pay for life insurance that will hopefully be sufficient to pay the tax when I die. That is, and we also spend a fair amount of time just figuring out how to plan our estate for that transition, and a lot of money. I just paid an $8,000 check to a lawyer to help figure all this stuff out. So how does my family and I, how do my family and I live if all my salary is going elsewhere? We have to pull equity out of the company, and that's equity that could otherwise be invested towards more chemists, more laboratory equipment, more capacity, any number of things. But my preference, as I stated, is that rather than an R&D tax credit, which I love, by the way, because it offsets this stuff a bit, I would much rather just be able to keep the money that we make through hard work and manufacturing. We've proven that we're a good investment, and I think we would be a good investment going forward.
One quick follow-up question. When you said you could invest the money back in the company, would that perhaps allow the company to grow and potentially hire more employees as well, so other people are benefiting in the community?
Yeah.
Okay.
Let me elaborate on that. 20 years ago, we had about 100 employees. Now we have about 450. We grow.
Okay. Thank you very much. Madam Chair, rather than ask questions, I think I'd like to defer to my colleagues, and if you're doing another round, I'll come back and get these gentlemen the next round. Thank you. Yield back.
Ms. Hirano.
Thank you, Madam Chair. I'm particularly interested in the biodiesel industry, and I visited with Pacific Biodiesel. I hope they're members of your organization.
They're not members, but we deal. They're
Good, they should become members,
Yeah.
probably. And the great thing about biodiesel is that it reuses products, and in the case of Pacific Biodiesel, they use hotel and restaurant oil, which otherwise would have to be disposed of with expense to those businesses. So, Madam Chair, I just wanted to mention to you that when I visited with them, that one of the first questions they asked was whether we were going to extend the biodiesel tax, and this was a real-life example of how the tax policies that we adopt here has an impact, and members of the industry, most of whom are small businesses, as you mentioned, they pay attention to what we're doing, so thank you for that. And Mr. Clemens, I just also wanted to mention that this committee has focused on the 15-year provision before, and so I want to thank you for coming and reiterating the importance of that time frame for restaurant renovations.
Well, we appreciate your work. Thank you very much.
Thank you, Madam Chair.
Mr. Goldman.
Thank you, Madam Chair. And I really appreciate your having this hearing. I think this is terrific. Appreciate y'all being here and the testimony. It's the kind of things people in Congress need to be reminded of apparently constantly. Apparently there's not a long-term memory here, and so we need that encouragement on a regular basis. Ms. Shepard, one of the last things you said is that if you had to pay tax twice on the same income, you said it would be a, quote, waste, unquote. And I would submit to you that it would only be a waste if you feel like you might happen to be able to spend money better than the wonderful people here in Washington. But otherwise, you know, somebody may need another monument to themselves up here or something like that. But
Reach to nowhere.
we had a small business congressional delegation trip to China 3 years ago, and one of the things we did was talk to CEOs, people that had moved businesses to China. And I went with the impression, I'm from East Texas, I went with the impression that probably they were just moving over there for cheap labor. And that was what we were told, a small part but of the reason, but the driving force for most of them was a dramatic decrease in taxes, and that China was even flexible if it was a big enough business on negotiating income tax, and that when they looked at a corporate tax half of what we have here in the U.S. and the advantages that they were able to have, even though they had better quality control in the United States, they like being in the United States, they just couldn't turn down that kind of tax break. And then since I've been here, I come to know John Bruton, who took over as Prime Minister in Ireland when they had one of the worst economies in the world, and now, as I understand it, they're maybe one of the top 5 fastest growing economies. And as best I can read and see, it sounds like the sole reason they turned that whole nation around from being one of the worst to one of the best as far as economies was they dramatically dropped the business tax. And now businesses are moving in there. People have jobs again. The kids are not rushing to get out of Ireland. And then, of course, he turned things around there, they did, by dropping their taxes. And now the European Union has John Bruton as their ambassador to the U.S. They wanted his input on how we turn Europe around. And now I understand that much of the European Union is looking at dropping taxes and following that lead. And we seem to be the only advanced nation in the world that's talking about increasing our taxes instead of decreasing them. And as far as the discussion about the death tax, there's been some good points made about that, but I can't forget this gentleman in my district in East Texas. He's a small business owner. They're in the timber business, and they have a bunch of land. And they're land rich and money poor. But he approached me and he said, "You got to do something about the death tax." I'm sure you're aware in 2010 there will be no death tax, right?
For a moment.
For that year. And then in 2011, it kicks back to the 55%, that basically a socialist notion that the government needs over half of the estate that's been accumulated despite taxes having been paid on all of that. And he said, my children are all grown, they're in the business, and they got together and hired an accountant who has advised them that if I die in 2010, they keep all of the estate, but if I have the indecency to make it to January 1 of 2011, they're going to lose half of the estate, and they're kind of encouraging me that, you know, not to take care of himself. And he said, I'm beginning to get a little worried if I make it to December of that year, if you guys in Washington haven't done something. He was kind of kidding, but you could see there was concern in his eyes. So anyway, I appreciate, Madam Chair, you having this hearing. I think everybody in Washington needs to be reminded we are hurting our country by taxing the people that are providing the jobs. So thank you.
Thank you, Mr. Gomer.
Overly taxing, that is.
Mr. Ellsworth.
Thank you, Madam Chair. I just made a note to myself, don't build any monuments to myself, and if I build a bridge in Indiana, it should go somewhere. I also was going to give Mr. Shepard a chance to elaborate, so thank you, Mr. Shabbat. Mr. Kilduff, you are going to benefit from Mr. Shabbat recognizing Mr. Shepard. You said you would like to address the carried interest. Sometimes in Washington, as you know, we implemented PAYGO, and you call out that as a pay-for. Would you elaborate? I'll give you my 5 minutes to elaborate on that. Unintended consequences, something that happens to us quite a bit up here, and obviously that's something we don't like, but please elaborate on that, help us understand that better, how that affects you.
Sure, I'd love to. I think in my notes somewhere I have the exact year. I think it's 2006, the last numbers we have. Somewhere near 50%, around 46% of all partnership tax returns that were filed in the United States were filed on real estate. And the typical form of ownership of real estate, and frankly, my own company, my operating company is an LLC, which is taxed as a partnership. When a small business developer puts together a project, like a shopping center project, you would go out and you would solicit the lease possibility from a food store. You would run the feasibility on the property. You would analyze all the costs. You would put all that together, and then you would go to someone else as a capital partner, and you would say, look what we have here. We have this opportunity to do this great project, and I'm prepared to give you a significant portion of the ownership in it if you're prepared to risk your capital. And they would come back and say, well, we will pay you a small fee, which is taxed as ordinary income, for managing this project, and we will allow you to keep a carried interest. We don't typically call it that. That's a financial term in real estate. We usually call it just an ownership interest. But we will allow you to keep a carried interest in this project, and when it is ultimately sold or whatever, you will benefit for having put this whole thing together, for having used your ingenuity, for having risked everything you own. Because every time I sign a loan at the bank, my home, my children's education, and everything is at risk, so I had better be right. But all I will earn in a project like that until they are paid back, until the project is successful, and ultimately, possibly, until the project is sold, is that small fee which is taxed as ordinary income on a regular basis. My entire interest in that project will be taxed as if I were a hedge fund operator. And that's a significant issue. And there are many, many more small partnerships and small projects and real estate investments in small companies like mine than there are hedge funds. And, you know, without beating up hedge funds, I just think there's a distinction there. And I don't know that anybody intended to harm the entrepreneur's efforts to put together a coalition of investors and partners to build something by taking away their incentive at the end of the day.
Thank you very much. Madam Chair, I'd yield back. Thank you.
Thank you. Mr. Faraci, right now, the United States can import biodiesel from another country, capture the tax incentive, and ship that product to another country for their benefits. They call this practice splash and dash. Can you discuss this issue and what the biodiesel industry's position is on such activity, and in what ways do you think we can stop these abuses to our tax code?
Sure, be happy to talk about it. Yeah, you described what a splash and dash transaction is pretty accurately. What you have is a situation where you take finished biodiesel produced in a third country, say Argentina, and then it will come to the United States. It will be splash blended with diesel fuel, because remember, that's the event that triggers the tax benefit. And then that fuel will ultimately be shipped to a third country for end use. Now, if you look at that, there's clearly no sort of energy or tax policy justification whatsoever for a transaction like that. And the National Biodiesel Board is vehemently opposed to splash and dash. We've been working for years to try to shut these sort of transactions down. I can tell you it was clearly an unintended, no one foresaw this when the tax incentive was put in place in 2004, that this was going to happen. Now, the good news is, H.R. 6049, the Energy and Tax Extender package that passed the House prior to Memorial Day, as well as S 3355, which is the Baucus-Reed bill, and the McConnell-Grassley substitute as well, all address this in the same way. And what it says is, it says that fuel produced outside the United States for use outside the United States would not qualify for the tax incentive. So if you think of how that transaction works, that would shut it down. And furthermore, the effective date in all three of those packages is May 15th of this year, which was the date of first committee action in the in the Ways and Means Committee when they marked it up. So we're fully supportive of that provision. We think it's a good provision. These sort of transactions need to end.
Thank you. Mr. Berlingueri, the investment tax credit, we know, is essential to the solar power industry. And the growth of solar power has spawned new businesses that play a variety of roles in manufacturing and installation. Can you talk to us about how this technology has presented business opportunity for small businesses?
Yes, in an effort to make solar power cost-effective and allow consumers to afford to buy solar power, and today it requires, I believe, tax incentives for consumers as well to be able to do that. The processes that are used to make a more effective solar power are very similar to the semiconductor manufacturing processes. And so there's a number of companies that have either been in semiconductors only, that have been able to enter into the solar market and design equipment that will help make those tools, which obviously are employing people, and then actually make solar panels, which are also employing people as well. So again, we're able to produce equipment for solar, for making solar panels. We're able to produce those. Unfortunately, without those incentives, it's likely that the control of that will be outside of the United States, which we already have issues with in terms of our fuels and other, resources.
So if the tax incentives are in place, do you have any projections in terms of numbers of jobs?
Well, I had quoted the study that was done that at least over the next, I believe it was the next couple of years, that could provide about 40,000 jobs if the incentives were in place so that the equipment companies and the producers of those panels, installers, could be in the United States. That would be at stake, as well as about an $8 billion capital investment.
Yeah. Mr. Shepherd, as you know, our economy is becoming increasingly global. And as a result, investors are deciding between putting their capital in U.S. firms versus our foreign competitors. If the R&E credit is not extended, do you believe investors may be more likely to invest their money abroad?
I'm sure they will. That won't be our incentive. We're going to follow our customers where it makes sense. We have a couple manufacturing facilities over in Europe, and we did so we bought them back in the 90s when when our customers were going global. We have a lot of business in China for various reasons. We've decided not to put a facility there. I'm sure plenty of people will be influenced by the presence or absence of an R&D tax credit. I don't think it's going to make any difference to us.
Thank you. Now I recognize Madam.
Thank you,
Mr.
Madam.
Chabot.
Thank you, Madam Chair. Mr. Kilduff, I'll come back to you if I can now. The redevelopment of idle urban retail centers, some of which are affected by brownfields, as you had mentioned, seems to be a key to revitalizing struggling neighborhoods, and I have some neighborhoods like that in my area in Cincinnati. Could you tell us how the expensing incentive has helped your company to undertake these new projects?
Well, the expensing provision helps because the brownfield and the cleanup costs are incurred at the very beginning of the project. They're a large unknown. In the real estate development business, everything from the ground up is something that you have a pretty good handle on. You know what the building's going to cost because you can get estimates. You have engineers that can give you costs on many things. But the minute you put a shovel in the ground, or in the case of an urban redevelopment, the minute you have to start taking a building down and you don't know what's inside it, the risk factor goes up extraordinarily. And so looking at a cleanup of a brownfield as an exercise and an additional cost to the project, not knowing how much it's going to cost, but knowing that if you have to incur that cost, at least you will be able to expense it and not have to depreciate it as if it were part of the building over a long period of time, significantly affects your go or no-go decision because it's at the front end. So many projects, you don't even know they didn't happen. They just don't happen. You don't know if anybody ever looked at them or not.
Okay. Also, the new markets tax credit encourages private investment in underserved areas, and I also have a number of those areas in my district that we've worked with new markets and had things actually occur that wouldn't otherwise have occurred. Could you discuss new market and how?
Sure. I've been involved in the New Market Tax Credit Program for a long time in the sense that I was involved with two organizations, LISC and the Enterprise Foundation, when they originally were trying to come up with the program. It was originally, the concept was that it was going to be similar to the tax credit housing project type of thing, where it was going to provide equity and it was going to fill the gap. In many of these redevelopment projects, there's a significant gap between risk and return, and the risk and return in some other project somewhere else that will attract the capital instead. So the New Market Tax Credit does serve that purpose, and it has worked with some effect. I will tell you that for many small developers, it has been challenging to use the program because it's complicated, and the allocation of the tax credits often go to banks, and those banks often have selected or elected to offer the value of that credit at slightly below the mortgage rate at the going time and retain most of that leverage or most of that additional gap-filling possibility for themselves. And so I think while we support the renewal of that program, I would also urge the Congress to look at making that, streamlining that program and making it more targeted toward the actual purpose that was intended.
Thank you. Mr. Burlingame, do you believe that the R&E credit would be more effective, especially for small firms, if it could be made permanent, if we knew it was going to be in existence, we could count on it, depend on it.
Yes, I would agree. I would believe so. I think that when we look at our businesses, especially in the area of product development and R&D, the long-term commitment to activities are critical. Most products take multiple years to get to market from concept to release and design. So I think that that's critical to us. That's why we have asked for it to be extended beyond this annual type of activity to 8 years, so that we can make a long-term investment and know that it's not going to dry up a year later. And so it does, our model, and I think the members of SEMI who are doing R&D have a long-term commitment to R&D, and they need it in order to produce a product. It's not a 6-month activity, it's a multiple-year activity.
Okay, thank you. And finally, Mr. Shepard, we had talked about the death tax or the federal estate tax earlier. I'd like to give you one opportunity again to go on another issue. We talked just briefly about LIFO and the challenges, the problems, et cetera. Could you tell us what LIFO is and what you think ought to be done about that?
Sure, thank you. LIFO is a method by which profits are determined for purposes of tax. It stands for last in, first out. So my business is very heavily raw material intensive and involving many commodities, and the prices on commodities change over time. The LIFO provision offsets. Last in, first out says that when I determine my profit, I am looking at my most recent price on a raw material purchase rather than my most distant. So the profit is calculated based on my replacement cost of that raw material rather than really on speculation in the market. I understand that that's that there's discussions going on to eliminate the LIFO tax provision, and that would be disastrous, and I think it would be wrong-headed. It's wrong-headed because if we do a lot of business with a metal called cobalt, and you have a chart in the packet, I don't know what it's even called, that I handed out, my written statement that shows the volatility in the price of cobalt. It is quite volatile, and if the price, say, started at $10, and at the end of the year it's 20, and in some years that would be a mild increase, the first in, first out method, which is what we'd be looking at if LIFO went away, would assign profit to our company for that $10 per pound that the price of cobalt increased. That's not money that we have available. We've invested all the money that has come in because the price of cobalt went up back into working capital for our company, back into cobalt that's in our inventory. So at the very time, if LIFO were eliminated and we switched to FIFO, at the very time that we are cash strapped because the price of cobalt, for instance, went from 10 to 20, and we had to finance that increase in that raw material, the government, under FIFO rules, would be looking for dramatically increased taxes. And then on the other hand, cobalt does go from 20 back to 10 also. At the very time when we're rolling out at the very time that we're responding to the reduced price of cobalt with our prices, and we're gaining the benefit of lower priced cobalt in our investment, in our working capital, and therefore are cash rich, the government would be saying, no, you're losing money because your prices are coming down. So it would create tremendous complexity in our cash management and great inefficiencies, because when it's time to invest, we wouldn't have the cash, and at other times we'd just be flush with cash.
Okay, thank you. And I don't want to open it up too much, but the other gentleman here, do you all agree that that also is a would be a significant problem in various other industries and something that we ought to be advised of and take into consideration in our tax policies. Is that a concern, or is there anybody that disagrees with that point of view?
I'm going to speak as a CPA. He's absolutely correct in what he's saying.
And will you please be brief, since we
I
are going
will.
to recess at 11:45?
I will.
Yeah.
In my business, it's not significant because we have a very small investment in inventory. I'm sure he's got a very significant. It is exactly like he said.
Okay, very good. Okay, thank you very much. Yes, sir.
One last comment. Right now, because over time the price of our raw materials have gone up more than they've come down, we have about a $40 million LIFO reserve. If suddenly that went away and we had to pay, and that was recognized as income, we'd have 20 million, $18 million tax nut that we'd have to provide. We don't have that hanging around. That would be a big deal.
Thank you very much. Yield back.
Ms. Clark? They're going to have a service.
Thank you, Madam Chair and Ranking Member Shabbat. I'm sorry, gentlemen, I didn't get a chance to really hear as much of your testimony as I would have liked. I had another hearing it simultaneously, but I did want to get here to ask some questions because I'm concerned about the expiration of these tax credits. My first question is to Mr. Faraci and Mr. Shepard. Due to a research and development tax credit expiring last year, thousands of jobs were at risk, according to the Information Technology Association of America. These jobs stimulate more spending, business growth, which creates even more jobs. Now many companies no longer can rely on this credit. How did this R&D tax credit impact your business and your industry? If you can tell us just briefly.
We don't have a lot of our members aren't taking the R&E credit as much, but I can speak to the biodiesel tax incentive and the impact that it's having. And if with the tax incentive, we're going to continue growing, we're going to continue creating jobs and adding to the overall economy, and we're going to continue being a part of our answer to our energy security issues. Be part of answering the issues in terms of addressing climate change. If the tax incentive expires, because of the way we're structured, because of the impact it has in terms of being very fungible to make our fuel price competitive, those jobs are going to dry up. And so a lapse would be pretty devastating to our industry.
Mr. Shepard.
Yeah, thanks for the opportunity. I really can't speak for our industry. I don't intend to. As for my companies, the R&D tax credit is really not so big an amount of money that it drives much of anything. We're happy to get it. My real message here was taxes in general are very onerous, and if the way to reduce my taxes is to get an R&D tax credit, I'm happy to have it. But really, other taxes play a much bigger role.
I think if it were made more meaningful in terms of how it impacts on your business, in other words, if it were to give you the type of cushioning you need to move forward with new innovation, it would be something desirable.
We are a very innovative and technically
Exactly.
driven company. If it were bigger and more meaningful, it would absolutely influence us.
And Mr. Kilduff, how does the new markets tax credit, how has the new markets tax credit been a powerful tool to spur small business development in low-income communities throughout the United States, from your perspective? And then, does this credit stimulate investments in businesses such as neighborhoods, retail stores, and inner-city shopping centers? And would you agree that the new markets tax credit has created jobs in economically distressed neighborhoods? If so, do you have evidence supporting that claim?
Yes, ma'am. Actually, that's an area that I participate in, not exclusively, but a great deal of my business is in underserved markets. There is always an equity gap in an underserved market project. There is a gap between the potential return and the costs based on the opportunity to do things in other markets that would be easier. And new market tax credits, brownfield expensing, brownfield tax credits, if we could get a bill passed to do that. Those things all add tools to the, to the chest to allow us to even consider those projects. They have worked significantly. The tax credit program is a little cumbersome. And I'd urge some review of how those credits are allocated to the organizations that pass them out, but it is significant. It's significant.
And then, just in closing, Mr. Shepherd, do you believe that there should be a repeal of the deduction for expenses related to domestic energy production under the American Jobs Creation Act of 2004?
Boy, I don't know. I'm not very familiar with that.
Okay, okay. Madam Chair, thank you very much.
Mr. Aiken?
I'm sorry that I haven't had a chance to join you because we have multiple committees at the same time, but did note yesterday, I guess it was yesterday's Wall Street Journal, that they were saying something about a tremendous oversupply of strip malls and malls in general, everything like that. Does that mean we don't need the tax credits we've already overbuilt, or what do you think about that?
My dear friend Gar Herring was quoted in that article, and we're going to have a talk, he and I. I'm not so sure that everybody would agree with the entire article in terms of the overbuilding. I think, having been in the real estate business as long as I have, since before the '86 tax change, and watched capital structures changed, and I think retail is suffering some of the consequences of weakness in other parts of the economy. But frankly, we are much better as an industry now about building things that are pre-leased and building things that are necessary at the time and are substantially reviewed. That does not mean, though, that if everybody starts losing their homes and other businesses start closing and people stop shopping, that it's not going to look like we have too much retail, or that some retailers aren't then going to have to retrench, close stores, potentially even declare bankruptcy, which then fulfills that cycle and puts us in that position. I would submit to you that it's not quite like that. Having said all that, even through all of these endeavors in what is primarily a suburban development business that's taken place in the last 10 years, many of the projects in the urban markets still haven't been done. And they haven't been done in part because those were easier to do. And the reason they were easier to do is because when you measure them under the same time frame and same parameters as those urban deals, the suburban deal always came out on top. So things that can be used to help manage that and put the projects where many people are living, which have been abandoned for some 30 or 40 years, could be a significant value.
Well, thank you for answering that question. It does obviously depend on your assumptions and parameters and where the economy is going and all that. One other quick question. I don't know that this was something you addressed specifically or not, but as a guy who's been here now 8 years, when we did the dividend capital gains tax cut, which was politically a pretty unpopular thing to do, it appeared that almost immediately after that, there were 3 charts that I have in my office, that there was a tremendous effect in the economy. The first thing was we were running at losing about 140,000 jobs a month rate. And within almost instantaneously, first quarter of 2003, when we did dividends capital gains, we turned around and saw a fairly steady increase in jobs at about 160,000 jobs gained per month. Very big turnaround. The gross domestic product had been very erratic up and down for the first number of because I came in with the president, so the 2001, 2002, very up and down quarterly gross domestic product. That jumped up from about 1.4 average, but it was, as I said, erratic, to about, up into the 4s. And the third thing is that government revenues also jumped up significantly. Even though we did tax cut, the result was you had enough business stimulation from dividends, capital gains, apparently, that you had a tremendous increase in federal revenues. Now, I'm making the assumption that there was a causal relationship between the dividends, capital gains tax cut and what happened to the economy. That may or may not be true. Is it your opinion that tax cut is very important to business in general, or do you think there's other tax cuts you think are far more valuable?
Well, in my business as a real estate developer, it's probably the single most important thing that we look at in terms of whether we build something, how long we hold it, what we do with it, how we structure the capital. And that's why, so capital gains taxes would be significant for us. and increases there would be more devastating than many other things. The carried interest issue is also of significant importance for that very same reason, because most small developers own things that they don't profit from until it's ultimately sold at the end of the day, because everybody else has to be paid back first. We're in the risk position. And so those two things combined could be devastating to small business.
The other members of the panel, is that an important tax cut, dividends, capital gains, relative to your businesses?
Well, I think the way I would comment on it is that we're expected to make a significant return on investments that we make. When I get a personal tax cut, I probably get a one-for-one return, and sometimes I may not even do that. But as a responsibility for a business, I have got to make a bigger return on it. So I think that investment does look for a larger return that creates more jobs and a healthier economy. So I absolutely believe that that's the case.
I would just say that anything that reduces the capital gains tax cut helps markets be more efficient, which allows money to go towards the best opportunity rather than being constrained by some artificial barrier.
So you're saying the dividend capital gains tax cut, from your point of view, is very important to the strength of the economy?
I think it's very important. I think it should be cut further.
Okay. Thank you, Madam Chair. I'd vote for that, too, by the way.
Unfortunately, we don't live in the perfect world, right? Okay.
We're trying to make it such.
Yeah. Well, you tried for 12 years. Okay. Thank you so very much for your insights and great discussion that we have this year, in this hearing. Let me just say that as the 110th Congress come to an end, this committee will continue to work with the leadership and our colleagues on the Ways and Means Committee to make sure that some of these extenders are signed into law, are passed. Some of these provisions have already passed the House, so we need to get the Senate to act. And we will continue to highlight with our leadership the important consequences of these tax extenders when it comes to small businesses in this country. Thank you very much. And with that, I ask unanimous consent that members will have 5 days to submit a statement and supporting materials for the record without objection. So ordered. This hearing is now adjourned.
They just announced no votes tomorrow. Thanks, Jan. Okay, yeah, take care, you too.
Thanks, Steve.
Shepard mentioned it when he said jobs are what solve life. They don't solve them all, but they solve one. That's what that discussion. Thank you again.
Really appreciate it. Really appreciate it. Sure. We're having discussions.